What if the money you celebrate every April was yours to keep all along? Every year. According to 2023 IRS data, roughly 72% of American taxpayers receive a federal tax refund. The average federal tax refund check for 2023 was approximately $2,753. Most people feel relief. Some feel joy. Almost nobody feels suspicious. And that's the problem. Here's the core fact. A tax refund is not a bonus. It's a repayment. All year, your employer withheld more money than you actually owed in taxes, and the government held that surplus, interest-free, until you filed your return. That's the mechanism hiding in plain sight. Over-withholding. The government isn't doing you a favor by holding your money. You gave them an interest-free loan, and they accepted it every single month. Financial intelligence, the ability to understand how money moves, compounds, and multiplies, separates citizens who build wealth from those who stay stuck. A 2023 TIAA Institute study found that adults who scored highest on financial literacy tests accumulated nearly 3 times the retirement assets of those who scored lowest. The misconception is seductive. A big refund feels like found money, a windfall from nowhere. But found money doesn't come from the government. It comes from your own paycheck, deducted weeks and months before you ever saw it. Picture 12 pay periods. Each one $250 more than necessary flows out of your check and into a federal holding account. By December, $3,000 of your money has been sitting in Washington, earning you nothing. Here's where the story gets costly. That $3,000, redirected into a high-yield savings account earning 4% annually, generates $120 in interest just by sitting in the right place. Compound interest is where your money earns returns on both your original deposit and every dollar of interest already added. It's not magic, it's math. But it only works when your money is in your account, not the government's. Now make it worse. Suppose you're carrying credit card debt at 20% interest while simultaneously over-withholding. Every month, you're paying the bank to borrow money while lending your own money to the government for free. 2 losses, 1 paycheck. In Oroville, this district is called the Borrow Badlands. The Federal Reserve reports the average American household carrying credit card debt owes around $6,500 at rates above 19%, meaning over-withholding and high-interest debt are draining the same paycheck from opposite ends at once. So what's the actual mechanism for change? A single IRS document most people fill out once and never touch again. The W-4. This form tells your employer how much federal tax to withhold from each paycheck. Adjust it, and you adjust your monthly cash flow immediately. Step 1. Estimate your actual tax liability for the year. Input your income, deductions, and credits. The tool calculates exactly what you owe. No guesswork, no accountant required. Step 2. Submit a revised W-4 to your employer's HR department. This isn't a tax filing. It's an internal payroll instruction. Your employer is legally required to implement it within the next pay period. The change is immediate and reversible. The result: your take-home pay increases starting next paycheck. If you were over-withholding by $250 a month, that's $250 landing in your account every single month for the rest of the year. Here's what surprises most people. High net worth individuals engineer their withholding and estimated tax payments with surgical precision. ProPublica's analysis of IRS records found that Warren Buffett structures income timing to minimize idle tax overpayments because to him, idle cash is a cost he refuses to absorb. Wealth management isn't reserved for people who already have wealth. Vanguard's 2023 How America Saves report found that households actively managing cash flow and savings allocations, regardless of income level, accumulated significantly more assets over 10 years than those that didn't. The behavior matters more than the starting balance. Remember compound heights. Investing $200 per month at a 7% annual return for 30 years grows to over $250,000. The engine doesn't care where the money came from. It only cares that the money arrived on time. Every month, You over-withhold is a month that money isn't compounding. It's not a neutral delay. Compound interest punishes late arrivals. A dollar that misses 12 months of compounding at 7% isn't just a dollar lost. It's every future dollar that dollar would have spawned. Compounding isn't the only destination for recovered withholding dollars. If you carry high-interest debt, redirecting that monthly surplus toward paydown generates a guaranteed return equal to your interest rate. Paying off 20% APR debt is a 20% return, risk-free. Here's the distinction financial intelligence demands. Debt used to acquire income-generating assets can build wealth. Debt used to survive a cash flow shortage created by your own withholding settings is a self-inflicted wound. The psychological barrier is real. People fear owing money at tax time more than they value keeping it monthly. But owing a small, planned amount, say under $1,000, isn't a penalty. It's precision. You kept your money working all year and settled the bill at the end. One caution. The IRS penalizes significant underwithholding. The safe harbor rule requires you to withhold at least 90% of your current year's tax liability, or 100% of last year's liability. Stay within those bounds, and you owe no penalty. Scale this across the entire country. According to IRS Statistics of Income data, in 2023, the IRS issued approximately 116.9 million refunds, totaling over $516 billion. $334 billion of citizen money that sat in federal accounts, interest-free, for months before being returned. As productivity author Craig Ballantyne has argued, the rules you play by, not just how hard you work, determine your financial outcome. The withholding system is a rule. Most citizens accept it as fixed. But it's adjustable. And adjusting it isn't a loophole. It's exactly what the W-4 was designed for. The same logic applies if you're self-employed. Instead of W-4 withholding, you make quarterly estimated tax payments. The goal is identical. Match what you owe, don't exceed it. Overpaying quarterly estimates is the same interest-free loan problem, wearing a different form. Life changes demand W-4 revisits. Marriage, a new child, a second job, a major salary increase, each event shifts your tax liability. Citizens who never update their W-4 after a major life change are almost certainly over or under withholding without knowing it. Here's a number that reframes the entire problem. A 2022 National Financial Educators Council survey found that poor financial literacy cost the average American $948 in a single year, from decisions exactly like accepting an oversized refund without question. The withholding mistake isn't rare, it's the default. Consider this. The modern payroll withholding system was introduced during World War II to ensure the government received tax revenue immediately, rather than waiting for annual payments. It was designed for government cash flow, not yours. Knowing that changes how you read the W-4. Here's the example made concrete. A citizen earning $60,000 annually, over withholding by $250 per month, who redirects that amount into a 4% high-yield savings account, accumulates $3,000 in deposits, plus approximately $60 in interest by year's end, instead of a refund check that earned nothing. Back to the question that opened this. What if the money you celebrate every April was yours to keep all along? It was. Every dollar of that refund was yours. The only thing standing between you and it was a form, a calculation, and the knowledge that you had the right to change both. This week, run the free tax withholding estimator, submit a revised W-4 to your HR department, and put your own money back in your own account, where it compounds for you instead of sitting idle in Washington.